Let's take the conversation forward. Anurag Singh from Ansett Capital joins us on the show right now. Anurag, hi, good to have you on the show. Anurag, how do Indian investors read into to all the global developments? Because the biggest fear is that money is more going to move out, to China, and that's going to pull out of India. Is that the right thought?
Yeah, Aisha, morning. So look, interesting conversation. I heard most of it. Uh, Let me add two broader perspectives here. One is, look, we've always worried about the FII selling, FII buying, but I think I've always believed that at any point in time, you should look at your metrics and decide whether I should buy or not. Nobody is forcing DIIs to buy. They should not be buying. I understand the compulsion of not staying so much in cash. But at every point, every investor will have to see what is their threshold of buying and what they're buying for and what's their long-term trajectory. We can't blame FIIs because that money is anyways fly by night, that can find ways across the globe, and wherever they find cheaper valuation and risk reward perspectives, I mean, the money is going to flow there. Right now, the situation is this. China this time, I mean, they've released 100 billion. I mean, they've made available $100 billion just for the buybacks. Indian market in the entire year receives a liquidity of around $50 billion. Indian market is about 5 trillion, Chinese market is about 9 trillion. So they've released 1 year of, and I mean, proportionate to the Chinese market, they've released 1 year of SIPs together, and that's only government buying. So imagine the extent of rally it can just create in the Chinese market. I will just use two quotes. One is by Professor Jeremy Siegel. He says, look, you can't go wrong at a PE of 9. I understand it's China, but it is still a capitalistic country. It might have a government which is communist, but I mean, it was really too cheap. And in the last week, I haven't seen, I mean, it is the record buying by hedge funds in China. So I don't think this is stopping like so much in a hurry. Dave Tepper famously said, "What do you buy in China?" Well, he said everything, and no wonder, he is placed in all these major Chinese stocks. So I think this is going to be, I mean, this is important, but at the same time, coming back to India, I mean, look, take your own judgment. If the price is not right, I've always been a proponent that look, the age of secular buying and sitting for 20 years, that's gone because there's so much money chasing the market all the time. You need to be used to I mean, of course, timing is difficult, but timing is the only thing which is going to keep you, in the money, in exponential path to money making. Secular runs are more or less over, and I think we're going to just see. I mean, you spoke about liquidity. This liquidity is all going to be wasted in giving exits to the foreign investors. Forget foreign investors, even promoters and private equity. That's the bigger reason to worry. So I think, and by the way, investors need to learn this lesson all this while, right? So there's nothing unusual about it. Aisha.
Uh, Anurag, so what will influence the script of how markets would move? Will it be China? Will it be geopolitics? Will it be this churn which is happening from India to China? What will influence the script of financial markets in the near term? Because suddenly there are a lot of vectors which are at play.
Yeah. So, Nikunj, one is US. By the way, I mean, it looks pretty safe. Rates are being cut. Economy is strong. Job market is holding. So, US, there is no worries, except that, the only thing is the rest of the market has to catch up to these 7 magnificent stocks that were there. So, US seems pretty safe there. Amongst emerging markets, Mario Draghi last week, I think, came out pretty strongly in terms of, that Europe needs to really do something. He recommended a stimulus of 4 to 5% of GDP in investments. I think a thought is going around within Europe as well that, once we survive this inflation, the stimulus has to come in. And China, now we see that, the government couldn't wait any longer. So overall, the theme globally is that inflation is behind us. People need support. The money easing has to be carried out by central banks. And the governments are ready to provide that stimulus support across. So I mean, that said, this is all minority. This is all kind of minor blip. Indian economy persistently is in such a sweet spot for next 20 years that there's no other country that can match it. I'm trying to think about a write-up on this, and it'll shortly come out on ET Prime as well. But there is no stopping India demographics for the next 20 years. But that said, markets can price in too much at times, and that will have to be just accommodated. There was too much complacency around, how the 15% year-on-year CAGR is just almost guaranteed. And I think that's just some lessons need to be learned there.
Appreciate your time. Thanks so much for putting into perspective how we should be reading into all of the latest developments and what that could potentially mean for the global markets as well as India.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.